Hope you had a good Canada Day. We're going to pick up where we left off. Any questions before we get started? No? Everybody's good? Reviewed the videos? Any questions on anything we covered? No, everybody's good? That's good. That was easy. Okay, so quick recap of the market. Market seems to be going in a sideways pattern that we see. Couple trends that we're seeing. Just going to bring up the S&P. Okay. All right, so we can see that the
market data connection lost.
The trend here, you can see that we're in a sideways pattern here with the S&P 500, but the Qs look like they are still marching forward, creating new highs daily. The Qs represent the Nasdaq, tech companies. Now, some of the SPYs, the S&P 500 have those same companies in them. Let's see if we can get this back. But ultimately, we're still seeing what, bullish on the Qs, the Nasdaq, the S&P is kind of stuck in that channel. As soon as we get network connection here again, not sure why I broke. See, there we go. So the SPYs are in a sideways pattern. You can see sideways. Okay, so really this area here is where we'd like to see a breakout above if we want the bull market to continue. You can see the Qs though continue to rise, just continuing to make new highs. Now this is where it was before Corona, before the crash. You can see it's clearly above that now and continuing to rise. So there's still a lot of money in the market, a lot of money on the sidelines still coming into the market now. So it's very, I don't know, it's unlikely at this point because it's a bull market that the market would go down. It might come back down around here to retrace a little bit, come back into this area for support before it launches again. But right now, it's definitely still in an upward trend as it's been going up, and no reason to think that it's going to go down. It doesn't seem to matter that many states
market data connection reestablished
are seeing major increase in coronavirus cases. Deaths are starting to creep up. It doesn't seem to matter. The market just keeps charging forward. Now, last week we were talking about cover calls. Any questions about the cover calls that we talked about? Question, bought the stock, sold the call, the contract expired in 1 month. Do I just sell the call again without buying the stock? You mean if you still own the stock, yeah, you could just sell the call again. Is that what you're asking? If the call expires, it's worthless, right? You bring in that premium, so you could sell another call with the same 40 delta from wherever the stock is at the time and take in the premium again. Is that what you mean, Vincent? If you still own the stock, yes. If you don't, because they called it away, you'd have to buy the stock again. Does that make sense? Okay. All right. Which stock were you talking about? Is there a stock that you were looking at? Vincent, is there a stock you were looking at? Or anybody? Is there a stock you're looking at? You all there? Check for 2% against its original purchase price. I don't know what you mean by that. Check for 2% against original purchase price of stock. I don't know what that means. Check for 2% against original purchase price. So the stock, you own the stock still, is that right? I don't know what the 2% against it is. I don't know what that means. The stock's gone up 2%. What is the stock you're looking at, Vincent? Yeah, the new call would be based on the current price when you purchase the option, which should be a 40 delta from wherever the stock is at that time. What's the stock? Vincent, what is the stock you're looking at? BRO? This stock here? Is that right? Oh, BMO. Okay. All right. So BMO looks like a sideways to down pattern, a little bit of a down pattern there. I guess sideways from here. This channel here. I mean, you could do this. Let's see what the if we'd like to do this one, we'll look at the options for it. So let's look at BMO. Okay, so we go closest to 30 days, which is this one. And look at the current price, last price, bid ask, last was 53.31. So we purchased the stock there. So we could add the stock and sell the option, which is the 40 delta closest to 40, which looks at right here. Oh, sorry, delta 40 right there. So we would sell that. Okay, that would be our trade. Okay, so we bring in probably $1.60, closer to $1.60, but we just use the low number for now. So 155 for 55 investment, 44 days out. So if we calculate the risk reward or the return, my apologies, the return, we would get 1.55 divided by 53.31. Use the current price. It's about 1.55 divided by 53.31. So 2.9% is the return. Okay. So now the capital investment here is we'll use just as a cash account 53. So if I bought 100 of these shares, it would be $5,300, right? If I bought 100. So does that make sense, everybody? So we sold the the 55s. We bought the stock at 53 and change. So if we submitted or transmitted this order, the price that we would be looking at is 51.70 because it takes away the option off the price, because that's actually what we're putting up. And obviously we'd like the stock to continue to go up or sideways for us to collect that premium of 155. Okay. The only thing I don't like, a couple things, minor things I don't like about this Smithson is it's 44 days out. I'd like 30 days. 44 days out is pretty far out. I'd like to closer to 30 days. Looks like there's not many options. There's not weekly ones that could help us out with that. If there's weekly ones, we'd probably find something closer to 30. So 44 days. The return is good, 2.9, right, which is almost 3%. That's pretty good. I like that. And the other thing is that it's sort of trending down here. Not horrible though. Not horrible. Looks like it's got some support in this spot right here. I'd like to see that more upward than sideways, but that's all right. I mean, it's not terribly shooting down, but this might be, there's so many opportunities out there. This might be, something that you might pass on and look for something a little bit different. Is 40-day is still acceptable? Well, I mean, if that's all you have, yeah, I mean, you have to use it. You'd have to use it if you wanted to do it now. You'd have to use the time frame at 44 because it's the closest to 30. So you just follow the rules. The main thing is you follow the rules. Okay? And if the rules say closest to 30, then closest to 30. The rule says delta 40. Use the delta 40. Okay? The one thing you could do, I wanted to show you, maybe this is not the best one to do it with, but we can still do it with this. Is instead of buying the stock, right? So we don't buy the stock. What we do is we buy, let's say we buy, let's see, 40 would be 54, 53, somewhere in the middle. Let's do this one. Okay, so what we did here is instead of buying the stock, I bought the option deeper in, much deeper in, okay? I bought the option deeper in, at 40, okay? So I bought the 40 and I sold the 55, okay? I sold the 55. Now what I'm trying to do here by buying the 40 is I'm trying to minimize my exposure, right? I'm minimizing my exposure. Can anybody tell me why? So instead of buying the stock, I bought the option that's deep in the money. Almost a 1. It's 96. It might even go this deep down here. How would we do that? Let's go deeper. Let's go here. Okay? All right. So I bought the stock. I bought the option at 35 and I sold the call. So I bought the call option. I sold the call option at 55 with the 40 delta. Okay. Now, why would I do that? Who could tell me? Any ideas? Why would I do that instead of buying the stock? Anybody? Cheaper? Yeah. Less money? Yeah. Yeah. I don't need as much capital to do that trade, right? Right? I basically took a $50 stock and now I'm controlling a $50 stock for $18, instead of $50. What else? That's right. So less cost, less capital needed. What else? Anybody else? What other benefit would I gain out of doing it this way? The gains? How do you mean the gains, Rodrigo? It is a higher ROI. Yeah, it's higher ROI because I'm putting up less money. You're absolutely right. So it's a higher ROI. And what that allows me to do is to use less money to make a better return on the same trade. So it's the same trade. It's just instead of me buying the stock, I bought the option. So yes, higher ROI. So less money in creates a higher return on investment. Now I'm not going to make as much cash, like actual money, but I'm going to make more money for the money that I put up. Does that make sense to everybody? So the other way, I would make 155. I'm not going to make 155 on this trade, right? I'm not going to make the $1.55. Can anybody tell me what they believe I'm going to make on this trade? Instead of me making 155, right? What would I make? What would be my return? Can anybody tell me? Okay. Who's lost right now? Okay, look. It's okay. It's okay. All right, look. The stock is trading at 53.31. Okay, that's the stock. Okay, BMO. Okay, I'm trying to control this stock with less money instead of 53 because if I buy shares, okay, if I buy 100 shares, right, of the stock, I got to put up this times this, 53.31. That's cash amount, right? Cash. It's a cash amount, okay? Now, if I put up, instead of me buying the stock, 100 shares of it, I buy, right? I buy options, right? I buy options. I buy one contract, okay, at 1880, and that controls 100 shares. And how much do I have to put up? So I put 100 shares there because it's 18 per share, equals now it's $1,880 I got to put up. Does that make sense? Everybody with me so far? Okay. Now, let's look at the call that I sell. So I bought here, and I bought here. But I'm selling an option, right? So I'm selling a call, right? So sell a call, okay? And it's going to be for 1.55 per share, right? And that's going to represent 100 shares. So I bring in equals this times this. I bring in $155, okay? So if I stay here, right, here, buy the stock, $155, it goes 30 days and stays at 53.31. It stays exactly, what do I make? I make $155. If I do the same thing down here though, okay, I'm not going to make $155, right? I'm not going to make $155. Why? Because I'm paying a little more. Why? Because the strike price of this, strike price is what? It is 35, okay, per share. 35 per share. So for me, how much am I paying extra to buy the option instead of the stock for that period? Well, this is how I do it. I add these two together. 1880 plus 35, so it's 53.80. Okay, so I'm putting up 53.80 by avoiding to buy the stock. So I'm putting up how much? An extra what? 50 cents per share because I'm deciding to buy the option instead of the stock. Everybody with me? that make sense? Okay, so because when we do it over here, we go equals, right? If I put up this and I make this, what's my return? My return is, oops, equals, my apologies, equals this divided by this per share. So my return, my ROI is, let's bring that out, 2.9. Here equals this divided by, oops, how much did I put up? This. Look at my return. Everybody see that? Everybody with me? Okay, so instead of buying the stock, we can buy deep in the money call to control the stock the same way. I feel like some of you are a little bit lost right now. Well, and this is why it's important that for you know, if you have questions about cover calls, a regular way we do cover calls like this, that's why I asked, right? What is the actual profit? The actual profit. So the actual profit, right? So it would be, I make 155 for 1830, okay? But the actual profit would be, and actually if we go to expiration, so let me do this. I got to take out, how much did I use extra? So I go equals this, right, minus this. So I paid an extra 49 cents, yes? So if I take this to expiration, actual expiration, right, I'm going to lose that 49 cents. I'm actually going to lose that 49 cents. So really, this is no longer 155. I have to actually minus the 49 cents per share. So it would be, so this will be lower. My apologies. Because if we take it to expiration, which is what we should look at anyways, plus this. There we go. Okay. So now this becomes equals this. My apologies. This is more accurate. Because if we go to expiration, we're going to see 5.6. My apologies. 5.6 is the more accurate number. So I'm not going to make the full 155 because the stock, right, after this washes out at the end of the month or comes to the end of the month, right, I would be paying an extra 50 cents, so I'd have to take that off the premium. So the actual is more closer to 5.6. The actual money you make is $106. $106. Does that make sense? So instead of 155, I make 106. Because I had to pay extra, right? An extra 49 cents per share to control it, right? Instead of owning the shares. Okay, does that make sense to everybody? Well, I make 106 and I put up 1880 per share. Yeah, exactly. I make 106, right? For selling the call, I make 106 and I put up 1880. The reason I don't say 155 is I paid an extra 49 cents, right? I paid an extra 4, so I just took that off the premium. Okay? Now, this is called a spread trade. You could do this 100,000 different ways, actually. So many different ways you can do a spread trade at different levels, right? It's unlimited, really, as long as there's options to do it with. What we would do, as an example, this is just one single month. But what we could do is something called a calendar. okay? A calendar trade, okay? So instead of us buying this one on the same month, what we do is we go further out. So I'd go here. So I'm going to do a calendar call. I'm going to go here and I'm going to say, so I'm looking at that. I want to get as close to 1 as I can without going too deep. But let's say I do, let's say I do this one. Actually, you know what? I don't want to do that one because it's 55. 21 would be 56. 56. Let's do the rules. No, that's too low. 7 would be 57. Okay. So let's do this one. Let's do the 35 again. So I buy this one and I sell this one. Okay. So I'm buying 163 days out and I'm selling 44 days out. Okay. So I'm buying the Decembers. I could go further, and you'd actually want to go further. There's just I haven't gone more. Here, let's see. December, it only goes to December 20th. You know what? Let's use a different stock. Let's use a different stock. Give me a stock that you'd like to try this on. Because BMO doesn't have enough options. I don't like the amount of options. Trex. All right. All right. Let's see. No, it doesn't have a lot of options here. Let's do. Could we try something else? There's just not enough. There's not enough of these. Well, I guess you could go January. You could go January. Okay. So in this example, okay, we could go 191 days. I'd like you to try something 6 months or more out, right? 6 months or more out. Okay. So this is more than 6 months, so this will work. Okay. So let's say that we were looking at Trex. Now, obviously, we'd have to make sure we're in a bull market. We would have to make sure that the stock is running the way it's supposed to. The same rules apply. I wish that there was, 30 days, closer to 30 days, but let's just do this one instead. So 191 days. So I look down and I want to get deep in the money, not too deep, but I'd like to be around, I'd say stocks trading at 128. I could go 50% out, but I don't like 50% out because 95, like 50% of the stock, I don't like that because if I was using a margin account, I could get that anyways, right? So I probably as a and I don't want to get too specific as a rule here. Don't hold me because it depends on how far out we go and what we're paying. Okay, so let's say that we go 90 out. Okay, so I buy the 90, right, and I sell the 40 delta again, 40 delta, closest to 40, which is that one. So I sell that one. Okay, so that would be my trade. Now the reason I'm doing this is I'm basically I'm buying a long-term option, right, deeper in the money, and I'm selling covered calls on that option. Okay, the idea behind this is if I can do this 3 months or 4 months in a row, I do this 4 months in a row, then the option, the money that I've invested, I get it all back. Does that make sense to everybody? So I'm putting up, we go back over here, how much am I putting up? $45, yes? Everybody got that? $45, okay? How many 30-day periods are in 190 days? 6, yes? A little more than 6, but call it 6, yes? Everybody with me? So there's 6 90-day periods, at least in here, right? Okay, good. When I sell, and this hopefully would be closer to 30, on the stock it's not there. If I sell, it'd be somewhere in between here is what the price that I would get. Say, so there's $3, another dollar for 6, 7. Call it $7. $7. So how many times would I have to sell covered calls on this stock, $7, to get this amount that I've invested? $45. Okay? So with this one, actually, it's not very good because we're not deep enough. Okay? Or I could go closer out and do the same thing. Okay? So I don't have to go as deep. I could go, so at this level, it's not going to work because, you know, I'd have to bring in $7 for 7 months. Sorry, for 6 months to get 42. 7 months, basically, it's not worth it to me. It's not worth it to me. Okay? Does that make sense? There's not enough premium in here for me to make money in 3 or 4 months. Okay? So let me show you what I mean by this. Okay? I'd like to use a stock that we can actually look at. But if I'm investing $45.70, which it wouldn't be, it'd be somewhere in the middle. Okay? It'd be more like $43.50 or 44. Okay? So let's say it's $44. Okay? So if I'm putting up $44, okay, $44, I'd like to get, you know, if this is, I'd like to get, say, maximum 4 months. So 4 months, okay, that's the number of months, so months. I like it to be 3, but 4 months, let's say. And this is the price of option, right? Okay. I'd like to get per month this divided by this. So I want around $11. Why do I want $11? Around $11. Because I want my break even to be, you know, between 3 and 4 months, right? And that way the option now, my investment's covered. I'm totally covered. There's no risk for me. Does everybody understand that? So if I pay $44, you don't understand. Okay. If you pay, how we charge. So we're trying to find, I'm not going to use this stock, Rodrigo. It doesn't have enough options for it, and it's not paying very well. Okay. So let's use a different stock. Okay. Let's see BAC, see if it's got enough. Bank of America. Let's see where it's sitting at. Right. Okay, so there's more options here, more available, days. Okay, so look, if I go 191 days out, okay, 191 days out on Bank of America, okay, so I'm going 6 months, more than 6 months, okay, and I go, let's say I choose, what's it trading at? 2214. So this is going to work, okay, so if I choose the $20 strike, let's say, okay, $20 strike, I'm paying $4.55. You see that? Everybody got that? I'm paying $4.55. Okay. Now if I go back, and I'm going to get closest to 30 days, and I go 40 delta, which is this one. Okay. I bring in 80 cents. Okay. So let's go back to this. Price is how much? The price was, what did we pay for the let's go over here, 191 days, I paid $4.55. So if I go over here and I go $4.55, okay, per share, okay, I need roughly 4 months to cover. I'd want 114. Currently, it's not paying quite 114, so it's more like 5 months, right? 5 months, okay? So if I did 5 months here, it's around 91 cents. So I'd like it to be higher, the monthly versus the price. So I might have to instead of buying this one, right? Get rid of this one. Sell, buy this one. We could go here, 340. So let's go 340. I paid 340. Let's go back over here. 340. And I go over here. 340. Okay. Now it's closer to what I'd like to see. That's right about there. Okay. So what does that mean? What does that mean? So it means I paid 340 and I get to control this stock. I get to control the stock for how many months? How many 30-day periods are 190? 7 months, yes? Closer to 7, right? 7 months, right? So 7 times 3 is 190, right? Or sorry, 7 times 3 is 210. So 7 times 6 is 180. It's a little bit more, so it's closer to 7. But let's say it's 6. Let's say it's 6 months. Let's just stay at 6 months. I want it to stay at 6 months. Okay. If I buy it for 340 per share, and I'm bringing in about $1.85 per month, it'll take me 4 months to break even. That gives me 2 months free and clear with where I have zero risk. Does everybody understand that? Because the risk is what you paid for. You paid $3.40, right? 2 extra months of gain. Yes, exactly. Well, more than that, actually. It could be more than that. Because you actually, if the stock's still in the money, you could have the value of the option is still yours too, right? Does that make sense? So let's say it went sideways for 6 months. You'd still have, the stock at 22, it's trading at 23.14. So you'd still have $1.14 roughly of money in addition to those 2 months. Does that make sense to everybody? You'd have to sell 30 days out each month, right? So this month we're selling this one, right? 30 days out, which actually it pays, there's 30 days out right there, right? So 30 days out, 40 delta. 40 delta would be this one. So we'd make 89 cents. So actually we'd sell that one. You don't have to sell it. Okay? I'd sell that one. Does that make sense? So I'm bringing in 89 cents per month. So 89 cents is what I would bring in. So it's telling me if I was bringing in 89 cents every month, I paid $3.40, okay, per share, right? I bring in 89 cents. This is another way of looking at it. 89 cents equals how many months would it take me to break even? I take that divided by that, 3.8 months. So basically 4 months. 4 months. Okay. Now if the stock stays sideways and it stays at 23.14, which is where it is now, I'd also get not only the extra 2 months, so I make 89 cents times 2 months, right? Because I had times 2 months, so equals, 2 months. So equals this times this. I make another $1.78 from the options, right? Plus I make another $1.14 from the stock. Does that make sense? The other thing to keep in mind, folks, yeah, it's all right. We'll practice this again next week. The other thing that you got to keep in mind is I only have to put up 340 minus the 85 cents. So this trade is going to cost me this. It's actually 89 cents. So 89 would be 251. So equals. So for this trade, because it's 340 minus 89 cents that I've put in, right? This trade's going to cost me $251, right? Times 100 shares. So what's this trade going to cost me in my account? $251 to do this trade. Everybody with me? Once you buy the 30 days, you wait for those 30 days to expire, then you buy another 30 days, and so forth. Yeah, exactly. Yeah, exactly. 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 Any questions about this before I go on and explain this? Good. Any questions about this? Okay, so let's look at a couple other things here. Okay. What's the risk? Who can tell me the risk? What's my total risk? Well, where is the risk? The stock going bare. Yeah, the stock going bare meaning what, Rodrigo? Down. So the risk becomes, basically I can only lose the 251. That's all I can lose is 251. Okay? That's worst case scenario. 251. Okay? But you got to remember, I still control this option for 6 months, over 6 months. So if the stock does go down, can it go back up? That's if the stock goes down. Yeah, and that's if the stock goes down and I sell no options. So let me give you an example of what I mean by this. If the stock goes down, it's trading at 23.14. Let's say the stock goes down to 20. Okay? The stock goes down to 20. Now, if the stock goes down to 20, my option is not going to be worthless, right? It's going to, because I still have time, right? I still have 190 days, right? But it's not going to be worth 340 anymore, right? Obviously, because now it's out of the money. First it was in the money, now it's out of the money. Does everybody understand? So all I have to do is I can still do the same thing I was doing before. As long as I sell options above the strike price of $22, because that's when I got it, right? I got it at $22, right? Remember that? I got it at 22. As long as I sell options above $22, I can still bring in a premium. Does everybody understand that? I can't sell an option, a short month option, below $22. I can only sell above $22 each month if it goes below the 22. Does everybody understand that? Because remember, I only control at 22, right? So 22 is my spot. I have to sell options above $22. I still control this for 190 days, right? So even though the stock's gone at $20, let's say $20, as long as I sell options above $22, I'm safe, I'm fine. So the likelihood of me, if I do nothing, I could lose the $251. But if I sell options, even if they're 30 cents, because the stock is below 22, I'm still bringing in money. Does everybody understand that? So the stock goes to 22. So let's say that I do this, and the stock goes to 22. So BAC, okay, stock's at 23.13. Okay, whatever reason the stock drops in month 1. Okay, so month 1. So let's go month 1. So this is 1, 2, 3, 4, 5, 6 months. Okay. So let's say the stock, for whatever reason, okay, goes down to $22. Okay. In that first month, how much did I bring in? I brought in 89 cents. Okay. Now let's say it's at 22. I'm not going to get 89 cents anymore, right? Everybody understand that? Because now it's not just, if you look over here and you see what the option is paying for 30 days out, okay? We look at 30 days. This is 24. It's $1 away, roughly $1 away. It's giving me 95, 90 cents. It's giving me 90 cents, 89 cents. If this stock went down to 20, it would be like this was, excuse me, $4 out, which is 27. You'd be looking more at 30 cents. Excuse me. Everybody see that? Everybody understand what I mean? If that stock went down to 22 and we were selling relatively the same distance from this one, it'd be roughly, I'd only be getting about 30 cents. So month 2, I only get 30 cents. Okay? Let's say it stays at 22. And I only get 30 cents every month. Okay? That's all I get. First month I got 90, 89 cents, and then I got 30%. Okay? 30 cents moving forward. Okay? If I sum that, how much is it? How much is it, folks? $2.39. Yes? Everybody see that? I brought in $2.39 with options. Is everybody with me? So what first month I brought in 89 cents. Second month, because it was below the $22, it went down to 20, and I had to get it, I bought the 22s. So the stock went down to 20, let's say, right? It's below the 22, but I still sold options, right? Because still had time. I made $2.31. If I put up $2.51 and I brought in $2.31, what did I lose? What was my risk? $0.12. Exactly. Exactly. Everybody see that? Everybody see that? Who's lost right now? It's all right if you're lost. Yes, exactly. Actually, it's not 120. It's 13 cents. Was it 13 cents? 12 cents. So 12 cents. So 12 cents times 100 is how much? What's your risk? Not 120, $12. There you go. No, not 1,200. $12. $12. Does that make sense? So 12 cents times 100. Yeah. Okay, good. Good. Now what if, don't worry folks, we're going to go over this again next week, okay? What if the stock goes up from 23 to, let's say the stock goes up to 25. Now it's at $25, okay? So now it's at $25, okay? Remember, I want to sell above the price, okay? So the first month I bring 89 cents, okay? And I can sell anything above the 25 is what I want to do. I want to sell above the 25. So I'd go 40 delta, and I'd still sell above 25. And I get another 89 cents. And let's say it stayed there the whole time, okay? Okay? So I made 89 cents, because it stayed at 25, okay? So how much would I make at the end of the month, at the end of the 6-month period? $5.34. Wait, but in 4 months you're not back even. Yeah, you are actually. Yeah, you are. You're still break even. You're better than break even, but break even, yeah, you would be. In example 22. No, you're right. You're not. You're not because the stock went down to 20. Yeah, you're right. You're right, Rodrigo. But this is, I'm trying to give you a worst case scenario, right? You'd still sell month, right? You know, that's saying we get at least 30 cents per option, right? Now the stock could go to $10 and you're not going to get 30 cents per option. But you can still, the point I want you to see is you can still sell options out as long as it's above the $22. You see what I mean? Okay. So this one, it went up to 25. I made 89 cents every month. So how much did I make? $5.34. Yes? Everybody see that? So I made 89 cents every month. But what else did I make? I didn't just make $5.34. I made the difference between $22 and 25, which is how much? That's right. So now I also make this minus this. So another $3. So my total is this plus this is $8.34, right? $8.34, okay? And if you looked at ROI, obviously, I'm hoping you're seeing the ROI is pretty big. If I put up $3.40 to get $8.34, what would be my return? What would be my return? My ROI? Pretty high, yeah? Equals this by income divided by investment. $245. Everybody see that? It's really a percentage. So, and you got to remember though, folks, we put up the 340, so you don't get $8.34, right? I got to take out the 340 from that, right? I got to take out 340. So actual money I made was around $4 and change, so about $400. But return, if I'm looking at actual return for what I put up 340 and I made 834. That's 300. That's 250% basically return. Now these returns are achievable because we're using options instead of stock. That makes sense? If we're using stock, we couldn't get those returns, or it'd be extremely difficult and rare to get those kind of returns, right? Because you can't get a 200% return. That means the options that you sold covered double what the stock was worth. So to sum up on the 25 example, you break even in 4 months, and in 2 months left is the real return plus the difference between the 25 and 22. Yes, yes, yeah, basically that's it. Yeah. Now this is the assumption, folks, that it goes to 25 and stays exactly at 25. This assumption is it goes to 20, and I put 22 because that's our spot. But if it goes to 20 and stays at 20 for 6 months, or at least below $22, right? That's what this example is. Say it's at 21, it stays at $21. It would look similar to this. If it went up to 25, it would look similar to this. Okay? Now it's going to be slightly different, obviously, in real time, right? As you do this. But the point being is you keep selling months, you keep selling every month, you keep selling every month, bring in rent. Think of it as a house. You've got the property now, you're controlling the property, but you're renting it. This is sort of like a sandwich lease option. I don't own the stock, but I control it. I don't own a house in a sandwich lease option, but I control it. And I'm renting it out to a renter. I'm renting it out. And I'm making cash flow every month. And as long as the value goes up, like in real estate, as long as the stock goes up, I'll make even more because when I close the deal, there'll be a difference between what I could buy it for, $22, right, and what I could sell it for. This is very much like a sandwich lease option. Does that make sense? I'm not owning the stock, just like in a sandwich lease option. I don't own the house, but I'm still renting it out and making money, and that income is coming from us selling options. Does that make sense? Good, good. So next week we'll actually run through some stocks, okay, with this scenario again. Now that you have a better understanding, and we'll get our head around this, because I would rather really that we focus on options instead of stock. It would be in real estate, the investor, the bank, or mortgage and tenant. It would be in real estate, the investor, the bank, or mortgage and the tenant. I don't know exactly what you're saying there, Rodrigo. So in a sandwich lease option, somebody owns the house. You do a lease option with them, and you do another lease option with someone else, and then when the deal closes, you close both lease options. Does that make sense? You will load this one. Got distracted halfway. Yeah, sure, no problem. So Rodrigo, do you know what does everybody know what a sandwich lease option is? So in real estate, let me show you real quick. No, I'm sure. Okay, I'll show you a quick example of it, okay? So in real estate, it would look like this. Everybody knows what a lease option is, yes? So a sandwich lease option is there's a house, okay, and there's an owner. So this is the owner of the house, okay? He owns it, okay? What you do is you do a lease option with them, okay? And they say, okay, we're going to do a lease option. I want $1,000 a month, and I want $1 for the lease option, for the option agreement, okay? And you can buy this house for $200,000 anytime over the next 3 years, okay? And then what you do is you do a lease option with someone else, and you tell them you want $1,100 a month, okay? And they can buy this for $220,000, okay? You do a lease option. Plus you ask for $5,000 for the lease option, okay? Everybody see that? So we're going to make $100 from the cash flow every month. So think of that $100 as a covered call, the call that you sell. So I make an extra $100. I'm still paying him his $1,000, but I'm keeping the $100. And then when the house is ready for sale in three years, right? I will make the extra $20,000 on the sale. But I don't own this house. I don't own this house. I don't own it. Sandwich lease option, I don't own the house. Someone else owns the house. I'm controlling it. That's what a sandwich lease option. They call it a sandwich because you're in the middle, right? Sandwich, a person there and a person there. Sandwich lease option. Doing what we just did, a spread trade, the trade that we just did is like a sandwich lease option. Exactly, I would say. It's exactly the same concept. Does that make sense? Good, good. Who's a little bit excited about these calendar calls? These are pretty cool, yes? Returns are really good. Risk is lower too. Good. All right. So what I'm going to do is I'm going to wrap it up. I'll post this. You can review it again. Please review it so we can get a better, so we can move a little faster, and we can continue on it. I'll do more examples of this, but this is basically what we're doing. Okay. I want you to consider not trading stock at all and just using options. Okay. To increase our return. Less money in, higher ROI. Okay? All right, I'm going to wrap the meeting up. If you're good, type in yes or Y. Good. Calendar call. calendar call. Okay? If you're looking at calendar call. Okay, folks, have a great evening.